Amongst the first in a line of major central bank meetings this week, the RBA and Bank of Canada met today to decide on monetary policy. Joining me now to discuss the Bank of Canada's central bank meeting alongside the Canadian economic outlook is Michael Gregory, Senior Economist at BMO Capital Markets in Toronto. Michael, thank you very much for joining me. Now, the Bank of Canada has kept the benchmark rate at a low of 1% for more than 2 years now. Is it fair to say little was expected in the market in terms of the Christmas rate cut? Also, judging by the tone, do you think the Bank of Canada is in any rush to move off these ultra-low levels?
Well, I mean, I think they still have this longer-term bias to want to lift their policy rates over time, so that remained unchanged. But when you kind of read through the text of the policy announcement, it does seem they're beginning to acknowledge the fact the Canadian economy is underperforming their expectations, and it's more to do than just with temporary factors. And they do also acknowledge that their the slowdown or the cooling in housing activity and household debt accumulation has started to unfold, which is quite encouraging from their perspective. But again, they feel it's pretty early, so very much a sense of stand pat. But it does seem to be that if these trends continue, that perhaps their longer-term bias may even be watered down a little bit.
Also, as expected, you mentioned there, the attention is still focused on the debt load of Canadian consumers. Is Canada's high household debt picture improving?
Well, I do think we are beginning to stabilize. I mean, when you split out debt between, say, mortgage credit and all other credit or consumer credit, the consumer credit part has slowed quite considerably. It is now growing slower than the pace of income. So from that perspective, that's good news. I mean, really what you want to see is not deleveraging. You want to see credit growth slow below income, so debt-to-income ratios improve, but you still have credit-based spending going on in the economy, so it's the best of both worlds. On the mortgage side, things have cooled off, but it's still growing more quickly than income, and so there's probably room for housing to cool further, but the trends seem to be established. It's early, but I do think we've seen the worst of the deterioration in household finances.
Well, the latest indication that the Canadian economy is slowing further came with last Friday's release by Statistics Canada on GDP growth. Considering the European and US uncertainties affecting foreign demand for Canadian exports and given below target inflation, is the Canadian economy still slowing at the pace you expected it to?
I do think the Canadian economy seems to be underperforming my own expectations right now. I mean, obviously, there are headwinds coming from the United States. There are headwinds coming from Europe, China, maybe starting to pick up. We will wait and see. So the global economy has definitely been a headwind for the Canadian economy. But domestically, it's been a little bit unsettling that Canadian businesses have become a little more cautious in their outlays, and I think that's reflecting their worries about the fiscal cliff, just like their U.S. counterparts. And Canadian households now are being a little bit more restrained in their spending, are saddled with record amounts of debt, and they've basically taken all the advice that's been given to them by the government officials, and they begin to cool it a little bit. And so it seems to me that the Canadian economy is underperforming. It's a little bit weaker than I thought it would be at this stage, and hopefully once the U.S. gets past this fiscal cliff issue and growth picks up, Canada should be able to ride those coattails.
Looking forward, Canada reports its November jobs data at the end of the week at the same time as the US. Do you think the employment report is likely to be another reading of lackluster growth?
Well, I think we're going to get a very middle-of-the-road kind of boring report. The last few months, we've seen a tremendous amount of volatility, very strong reports followed by extremely disappointing, weak reports. On average, the trend has been cooling off, but there doesn't seem to be any one of those special factors which tend to whip around the jobs figures for this month. So we're looking for just basically about 17,000 in terms of net new jobs created. That's about a 1/10 increase in employment. Boring stuff, but and much less than the underlying trend has been so far this year. So again, further evidence that the Canadian economy is moderating, but still creating jobs.
Speculation has already begun about possible candidates to become Mark Carney's successor as Governor of the Bank of Canada. In terms of selecting a new governor for the Bank of Canada, do you think it's going to be a simple task of replacing Mark Carney? Also, would you expect them to really deviate far from the BOC's current interest rate policy?
Well, I mean, once you do get a new governor, even if the governor is part of the current monetary policy decision-making body, you have a new person at the helm, and there is that chance that the tone of the Bank of Canada's pronouncements may change a little bit. I mean, that's quite conceivable. I think when they're looking to replace Mr. Carney, they will look both inside and outside the Bank of Canada and come up with the best possible candidate they can. There is that risk that the person who eventually fills those shoes may have a slightly different view. Let's face it, the Bank of Canada practices what they call flexible inflation targeting. They've got a little bit of leeway, and how you interpret that. So there is some leeway for the new governor to maybe take things in a slightly different direction if he or she wants to.
Just to close, I'd like to quickly move on to discuss the various outcomes for the US fiscal cliff. Michael, in your opinion, what's the percentage chance of an early deal or compromise or even no deal being reached?
Well, I think the odds of actually no deal getting reached and by the year-end deadline and then, calamity hitting, I think is actually quite low. There is a little bit of wiggle room in the first few days of 2013 before tax tables have to be changed and payroll tax remittances would have to be changed if tax rates change. But there is room for compromise, and I think the digging in of heels we're seeing now is very much just posturing. I think we will go down to the wire. There will be some volatility and some uncertainty, but I think at the end of the day we will get some immediate measures that will come into force that will provide some headwind for the U.S. economy and the Canadian and the rest of the global economy. But I think also there will be measures to be named later or fleshed out with more negotiations. Let's face it, the U.S. needs to get some tax reform done. It needs to get some reform of entitlement programs, and those simply cannot be done in the very short period we have now.
Thank you very much, Michael. A pleasure as always speaking to you. Now, we'll also be taking a look at the Canadian dollar in tomorrow's edition of Targets in Focus. But in the meantime, Dukascopy TV team will be conducting exclusive interviews on the financial industry, so stay tuned.